Welcome to the part 7 of funds transfer pricing video sessions. And apologies, first of all, that there was so big pause between the latest posting of FTP course and today. So it has passed several weeks, a good several weeks passed by, but this is driven by the fact that I was finalizing my third book and it was finally sent to the publisher. So now I can again focus on this video. So first of all, today I would like to continue with cost of liquidity. This is what we discussed last time, so about the cost of liquid asset buffer. I'm coming back to the correct slide. So first of all, we know that FTP, as we already mentioned before, is composed of 3 components. However, sometimes I hear that FTP is only 2 components, not actually 3, but 2. And the first one is obviously interest rate risk in the banking book component. Then we have the TLP cost of liquid of TLP of the cost of the maturity liabilities with maturity or without, but to which the term was allocated. And finally, the last one, which we started to discuss, is this contingent liquidity cost. The reason of the name contingent is because it is the cost allocated to cover the unexpected potential outflows of all stochastic cash flows. So as we know, we have at least 4 categories of cash flows. And one of these is when we have the timing and notional of the cash flow is deterministic. Another one when one of these, or timing, or the amount of cash flow is deterministic, another one is stochastic, and vice versa. And then we have the stochastic timing and stochastic size of the flows. And this is exactly what I was covering during the liquidity course when I was discussing why it is so important to differ between those cash flows, because one is with deterministic timing, another one we don't know where customer will be withdrawing. And as always in FTP, nothing is for free. So every time when you need to allocate because of the Basel III regulatory metrics and liquidity rules, where we have the stress test portion of liquidity covered by the liquid asset buffer, and this is because every bank needs to make sure there is always sufficient amount of cash to cover any unexpected outflow and to protect the bank against any potential run on the bank. However, run on the bank, no bank is safe and can survive run on the bank. But, any potential adverse scenario, we, regulator and the banks itself, want to be able to survive the time period under which they can put in place some mitigation action and therefore recover from the stress. So this is why all banks hold this liquid asset buffer. And as we know, this is the crucial point of short-term liquidity management and under stress and allocation of this buffer. So the tool to manage liquidity under stress is allocation and calibration of the size of the LAB, liquid asset buffer. Now, if we think about this buffer, the buffer is placed on central bank reserve account or is invested into high quality liquid assets, which are usually the government bond or supranationals bonds. So all highly liquid assets which of course have very liquid market outside, and there is always liquidity and there is very low haircut against those assets. And these are also the part of lab, and of course money which are placed on any nostro accounts which can be withdrawn at any time, and of course they are also protecting us potentially when we need to deliver or to place the money to customer. Of course they can be used for this nostro accounts. So this is part of the lab. However, lab will never be so profitable or provide us with the yield or return as investing in loans, because loans are, of course, long-term assets with particularly attractive pricing for the bank, so that it yields the net interest income of certain amount for the bank, and this is extremely important. This is not really the alternative for loan strategy or commercial strategy of the bank. The bank must hold cost liquidity buffer because there is the regulation, because there is this liquidity. This is the liquidity tool to protect against any unexpected events and to be safe. However, this is not the alternative to earn money. Just the other side. Quite often, funding of this liquid asset buffer, which, as we know, where is the asset, there must be liability. So the liability is obviously in different form. It can be, or we can allocate the certain tenor for the funding of liquid asset buffer. So we can say our lab is funded by 6-month tenor funding. Or we can say, actually, this is part of our asset range, and we are funding it in the similar way as we found assets, other assets. So there is this composition, the blended structure of liabilities, which are used to fund liquid asset buffer. And the funding usually is costing us more than return on liquid asset buffer. This is normal, especially when we have the lower rates environment. And for many, many years, as you remember, we had in Europe negative rates, in UK low rates, and also in US low rates. So therefore, the buffer was extremely expensive because it cost us more to fund this buffer than the return on the buffer itself. And this was because the rates on return on the reserve account was very low, very tiny, and the same on the potential treasury bonds, especially on those short term. So there was no sufficient remuneration which was provided by investment in lab. So it was a drag, profitability drag. It is, putting the drag on the P&L of the bank. However, sometimes we have to admit, in the history of banking, and it was especially quite recently, when we had the other way around. So the rates were attractive, were very high. It was unprecedented historical event when we have in 2022, 2023, and partially 2024, rates at a high level. Central banks, we are talking about in UK 5.25% in terms of the Bank of England reserve return. And the cost of funding lab was lower than in return on lab, and especially because of the treasury bonds and reserve account was yielding very attractive rate of return. And the difference was positive. So quite many banks were, let's say, boosting profitability in this way. So they were funding by instant access or lower cost funding, which was usually the instant access or notice account, and you could, or current accounts, and you could, of course, have this positive difference. So lab was actually providing you with additional profitability rather than drag on P&L. But it was quite rare event, and usually it was it lasted quite short time. At the moment there are only few sources of funding which are cost lower return that we are earning through investment into liquid asset buffer, but still this situation still exists. However, it will disappear once we go into the, normalization of the interest rate environment. Okay, why I am giving you this long introduction? The reason for this is because it is important to understand that contingent liquidity cost is nothing else like maintenance the liquid asset buffer, which is the main tool to fight against any adverse liquidity event. But as always in FTP, no free meals, which means all liquidity costs or benefits must be charged out or remunerated back to the business which give rise to this cost. So in this particular case, on the top of the cost of deterministic liquidity, I mean, of course, because we are funding through longer term liabilities or, liabilities with certain tenor, or tenor allocated or deterministic tenor. And under stress, we have on the top this additional liquidity. So cost of this liquidity. So this must be top up on the top of the FTP rate. Now, quite often I heard the statement, cost of liquidity is not part of FTP. The reason for this, because we had these two main components, which is IRBB and TLP, term liquidity premium, which is part of FTP, which is basically the main component of FTP. And then once a month, finance usually adjust this profitability of the business unit by cost of liquid asset buffer. So if there is the cost, they are charging out this cost to the business unit, which created the need for holding liquid asset buffer, because this is the thing that some assets, some liabilities, and in this particular case, we know that we have the non-maturing deposits, we have, overdrafts, we have the credit commitments, we have credit cards, and also, we are modeling any other items on the balance sheet which are not deterministic, which need to be backed up by this liquid asset buffer. So let's talk about one item on the asset side, one item on the liability side, and I'm going to show you this simple example of how we could quantify the cost to be allocated back to the business units. And this is the main topic of this video. However, I would like to, before that, to give you a very clear clarification. So the cost of liquid asset buffer is based on a regulatory metric, which is liquidity coverage ratio, or your own internal metric for short-term liquidity, which could be survival horizon over 3 months, over 6 months, over 45 days, whatever is your survival horizon. So the choice of the metric which is used for the calculation of cost of lab, is a contingent liquidity cost, is or LCR, or the one, if the one internal one is more prudent, is more restrictive, then use the more restrictive one. This is the rule. However, here I will show you the cost based on LCR. So, because otherwise, how do you know how much you need to charge to division, which is generating the non-maturing deposit for the bank? So this business unit, which is involved in the gathering or collection of NMDs, non-maturing deposits for the bank itself. How much do you know how you have to charge them because of this cost of lab? So in order to know how to quantify the number, you need to know two things. The first one, what is in general the cost of lab? And this is what we call here cost of liquidity. And cost of liquidity here means what is the difference between cost of funding liquid asset buffer and remuneration on liquid asset buffer. So this difference, which could be negative or positive, depending on timing, as I already said. So sometimes it is negative, sometimes it is positive. So of course we know that if it's positive, it means that it is a cost, that liquid asset buffer is a drag on the P&L. Meanwhile, when it's negative, it means that we have some kind of benefit because of holding of lab. So this is the first component, cost, and then, how much, what is the proportion of lab which is driven by this particular item of the balance sheet. So is it what, 5% of lab we are holding because of this product, or is it 10, or is it 20%? How much? And in order to identify this how much, we need to have the run-off factors. Run-off factors are these factors which are provided by LCR Delegated Act, which is telling you how much you have to allocate for each product. And there is very little room for interpretation, so your own interpretation, because it's all prescriptive by the regulator. So obviously there are some differences based on the jurisdiction, but majority standardized, and we will be using, this is why some people find it so attractive to base lab, to base it on the LCR. So just to remind very quickly what we are trying to do in this example. So in this example, I will show you the very basic methodology. I will show you three. This is the first one. How you can calculate, how can you quantify the cost of liquid asset buffer, which needs to be allocated back to this particular product. And we will do the calculation for the asset, for the liability, and then I will show you in general how you can, allocate, but slightly different methodology. But let's go step by step. So first of all, this methodology, which, as I said, in FTP, there is no one size fits all. So just to let you know that everything which is rational, justifiable, and support the bank is okay for FTP. There are some high-level golden rules, of course. It has to be transparent, it has to be methodologically correct, but there is no, which one is the better. This is up on the bank itself to decide. So this one is based on the match funding principle. So let's assume that we have retail loan with 50% inflow factor from LCR perspective. So this is based on LCR. And imagine this is 100 units, and this retail loan is maturing within 1 month. so is falling into LCR window of 30 days. So because only then you can, count it for LCR, because when it is under LCR window. Now, for this, in order to quantify, we need something which has the 100% outflow, so we can see the net outflow position easily, because we have 100 versus this runoff factor on the asset side. So overall, you will have the net outflow position, which is exactly what you need for LCR. So let's imagine we are funding this position with 100 units of interbank borrowing, which exactly have 100% of outflow runoff factor according to the LCR Delegated Act. So the difference between 100% and 50% runoff on the inflow. So overall, you have 50 of net outflow. So you know that basically this 50 units must be held under LCR because of this asset position. So let's imagine your limit for LCR, because you never have the limit of 100. 100% is the regulatory LCR limit, but no one is holding only 100. There is always a buffer. So you will see 110% or 150, 175, and usually smaller banks need to hold the higher buffer, because they must prove to the regulator, to the counterparties, that they are prudent, that they are always holding sufficient amount of liquidity to prevent any unexpected shock. Meanwhile, let's say that bigger banks, we can assume they have more diversified funding structure. They have intraday liquidity tools, which can, or sources of liquidity on the intraday basis, so they can always, fill in the gap if they have any need. So we expect bigger banks to run slightly lower LCR in comparison to the banks which are smaller, which need to run much, much higher LCR. So my point here is you will always have buffer. And buffer is because you never want to risk that you will breach LCR. So therefore, let's imagine that our LCR limit here is 110%. As such, you need to multiply this 50 unit of net outflow by 110%, which is your limit. And of course, it means that you will be holding 55 units of HQLA for this particular position. Now, we said that this is one factor when you calculate or quantify the cost of lab or contingent liquidity cost for this position. Because, of course, you know that there is overall rate, which is known call rate. We said cost of liquidity. So it's the difference between cost of funding HQLA and return on HQLA. And we said that if this number is positive, we are talking about the cost. If this number is negative, we are talking about the benefit. So in this particular example, we have 20 basis points of cost, which means that you have to multiply it very simply, 55 units by 20 basis points, which gives you 0.11 units for this particular position. So overall, the cost of lab for this position is actually quite small, and depends on, of course, the runoff factor and the call itself. So the difference between cost of funding and the remuneration. So this is the methodology which is for asset. Similar methodology will be for liabilities. However, in terms of liabilities, as we know, LCR has this particular concept, which is now 75% of cap. So in case inflows are higher than outflows, we know that then the concept of LCR is broken, because LCR is telling you what if the net outflow position, so what is the net outflow position, and I need to hold sufficient amount of HQLA to cover this net outflow position. But if there is more inflow than outflow, so we don't have anything to cover, because there is more inflows than outflows. So this situation is adjusted by mechanics of LCR by introduction of this cap, 75% cap, which means in case your inflows are higher than outflows, don't use these inflows, but calculate 75% of total outflow and use it as your inflow. Okay, so in this particular case, you will be always having a lower inflow than outflow by construction of this cap. So in this situation, we are also applying the match funding principle. So we have 100 unit of the liability position of time depot with 40% outflow. Let's imagine we are talking about runoff factor of 40%, 1 month window, LCR window. So you see that 40% is the outflow. So we are assuming that 40% of this position will go out within the 30 days, because this is the definition of runoff factor. On the inflow side, as I said, we are using match funding principle. So we have 100 unit of 1 month interbank lending with 100% of inflow factor, which means your inflows in this situation are higher than outflows, because 100% inflow versus 40% outflow on 100, which gives you 40 of outflow. So 100 versus 40 of outflow, which brings you to the situation where your inflow is higher than outflow. So implement here the 75% cap. So you have 75% of total outflow. Your outflow is 40. So 75% of 40% outflow gives you 30%. So in this particular case, you will get 30% of inflow. So net outflow position is 10, because it's the difference between 40 on outflow, 30 on inflow. 30 is driven by the 75% cap. As such, the 10 net outflow position will be the quantity which needs to be backed up by HQLA. But we know that our limit is 110%, as we already said. Multiplication of 110% by 10 gives you 11 units of HQLA, which needs to be placed against this liability position. But now we want to quantify the cost. We have calculated the size, but what about the cost? The cost, as we assumed, will be 20 basis points. So 20 basis points multiplied by 11 units gives you 0.022 units. So 0.022 of the unit gives you the potential cost which you will be charging for this liability position.